Good morning, everyone, and welcome to our DATIQ weekly market update. This is our update for August, wait for it, 30th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, back in the great state of Ohio this week, and I'm joined by Dean Croak, who's back in Massachusetts. He's our Principal Industry Analyst. Good morning, Dean.
Hey, Ken. How's it going? Guess you're getting ready for the big weekend?
Big weekend. College football opens up. The Buckeyes are taking on the Golden Domers over there at Notre Dame. Not a game I think is going to be particularly close, but I will be in the South stands screaming my head off. One of the 100 and some thousand folks that will be there to watch it in person. I'm very lucky to get tickets to that game, so I'm excited.
Awesome.
I know you'll be there in spirit, Dean, right? Cheering on the Buckeyes.
Yeah, I'll be. Well, I will because of you, but I'll be north of the border in Canada at the truck races in Quebec.
Oh, nice.
Doing my best in the environment.
Yeah, I wonder what's going to cause more global warming, all the grills outside of Ohio Stadium or all of the diesel north of the border.
Well, we do use paper cups as our token green effort for the beer.
Anything's better than paper straws. They taste bad and they disintegrate.
Yep.
So with that out of the way, this is not a show, unfortunately, about football and truck racing talk. We're here to talk about freight, trends we're seeing in the freight market, data, and most importantly, answering your questions. We were live in Denver last week, and we had a ton of great questions. We've really been on a roll with our listener questions, so we hope to keep that going. Go ahead and drop those in the comments or chat below, and our illustrious marketing team will get those over to us behind the scenes. I've been known to lurk behind the scenes there as well a little bit recently. So with that, I'm going to go to our key points of the week. So we're on a rate perspective, we're tracking very closely to 2018 levels. I think that's a trend we've been observing for a while. And Dean's going to give us a little bit more color on that in a couple of minutes, but that's something to keep a watch on. Reefer load post surge, again, ahead of Labor Day, where we expect to see some more refrigerated freight, and it's been hot throughout most of the country. We've had a cold front blow through recently for most of the East Coast, but it's been hot up until that point. Contract rates, again, following a very typical, predictable pattern of following spot rates downward. Nothing I would consider to be alarmed about. Again, just something to observe. Brake safety week, the impact was minimal. Equipment post dipped below a 5-year average. So that's, I guess, it's a good or a bad thing, depending on what side of the coin you sit on. And the Canadian spot market returns to normal levels following February 22 cross-border protests. That's a tongue twister. Load-to-truck ratio close to 2021 levels, but capacity continues to loosen. I will add, before we jump into Dean here, if you go ahead and look at that tropical weather map, it seems to be getting seasonally spicy. So that's something you might hear us talk about over the next few weeks. But I'm sure Dean will be able to add some more color as I turn it over to him now. Take it away, Dean.
Yeah, thanks, Ken. I talked to Chuck Snow last week about the Canadian market, and he did add that when we had him on last, the 20% of drivers that he said that kind of vanished in terms of drivers not willing to cross the border into the US still exists. So there's still a driver shortage going on up there as a result of the border protests in February. Anyway, let's jump into our market update for the week. Let's start off with our dry van load to truck ratio. As expected last week, it was the last full shipping week before the end of August. Load posts were up slightly, only by about 4%. As Ken mentioned, and it was kind of unexpectedly, I didn't think we'd see the numbers come in like this. I honestly thought we'd see more carriers take some time off. The 5-year average is about 6% drop in equipment posts during brake safety week. Last week it was only 2%. So more carriers kept working last week. So as a result of higher load posts and fewer equipment posts, the load to truck ratio in dry van moved up by about 5% to 3.45. In the refrigerated category, as Ken said earlier, shippers were positioning a lot of their temp control freight ahead of this weekend's Labor Day celebration. Load posts surged by about 13% last week. And while not as high as 2020 and 21 August volumes, the previous week's spot market activity was still about 25% higher than we see in pre-pandemic years for August. Reefer carriers typically take more time off during inspection weeks than their flatbed and dry van counterparts. Last week, there was a 4% decrease in equipment posts. The load-to-truck ratio was up 17% to 7.04. As you can see from the chart, flatbed load posts are tracking around 7% below 2018 levels as we end August. Last week, they were down 9% week over week compared to the previous year. Load post volumes in flatbed are now 60% lower after dropping about 30% in the last month. Carrier equipment posts were down 3% last week, but still remain at all-time high levels for the last week of August. And to gauge just how loose flatbed capacity is at the moment, equipment posts are about 51% higher than this time in 2018. The load-to-truck ratio this week was up slightly to 13.02. So having a look around our market condition index and our various markets, focusing on a couple of markets in particular, the port of Savannah, where there are 41 cargo vessels waiting to unload this morning, compared to just 10 in Los Angeles and 12 in New York City. In Savannah, load posts are up 17 last week. It's a heavily congested port at the moment. But kind of surprisingly, capacity was following the same trend as in Charleston, just to the north. Rates decreased slightly to about $1.91 per mile, so they're down 7 cents per mile last week. So even though volumes are up, there's plenty of capacity on the long-haul sector. Having a look at some of the other markets, outbound truckload capacity tightened in California last week, reversing the prior 3-week trend. The state average line haul rate increased 2 cents a mile to an average outbound rate of $2.18. Remember, these are line haul spot rates excluding fuel. In the Los Angeles market, which accounted for most of last week's rate increase, load post volumes were up 24% week over week. They're also up 27% month over month. A couple of lanes out of Los Angeles, one of the lanes that we watch closely that's tied heavily to retail imports is Los Angeles to Phoenix. Load volume increased 6% last week, although brokers and shippers found sufficient capacity with rates flat at $3.33 a mile. The other big lane that we watch is Los Angeles to Chicago. Spot rates continue to climb on that lane at $1.82 per mile. That's 11 cents per mile higher than the July average outbound rate. In the refrigerated category, like the dry van spot market in Florida last week, which was fairly active, load posts were up considerably out of Florida last week by about 19%. Rates only increased by about a penny per mile to $1.31. Savannah, again, heavily congested. Load post volumes in the reefer sector are up 3% week over week. Unlike dry van, line haul rates actually increased by 8 cents a mile to an average of $1.64 in the Savannah market. On the high volume Savannah to Atlanta, it's a short haul lane. Rates dropped to their lowest in 12 months at $789 a load. That's just over $350 a load less than this time last year. The other market that really is hot at the moment is the Pacific Northwest, not surprisingly because produce season is getting going. In the region, reefer capacity was tight last week. Rates were up about 6 cents a mile on average to $1.95. One of the bigger markets is Pendleton, Oregon. Reefer load posts have been climbing for the last 6 weeks, up 18% last week. Capacity continues to tighten as produce volumes start to ramp up. Rates were up in Pendleton 5 cents a mile to $2.01 last week. Pacific Northwest reefer lane level rates typically start climbing from now through year end. And they did just that last week for loads from one of the bigger volume lanes is Pendleton to Stockton. After dropping all year on that particular lane, rates turned the corner last week, increasing by 21 cents per mile to an average of $1.97. Our ratecast forecasting product is forecasting that rates on that lane will peak at about $3 a mile by the end of the year. That's about double last week's rate, but still $1 a mile lower than last season's January high of $4.05. In the flatbed market, like the reefer market in the Pacific Northwest, flatbed capacity was also tight following a 36% week-over-week increase in load post. Rates were up 10 cents per mile for all outbound loads. The regional average in the Pacific Northwest was $2.35. The biggest market up there, of course, is Seattle. Load post surged by about 63% last week. Outbound capacity was very tight. Rates were up 20 cents a mile to $2.34 for outbound loads in Seattle. In Spokane, the market to the east, load posts were up 42% in the last month, actually. Capacity was still flat, though. Outbound rates were averaging about $2.48. Pittsburgh last week, pretty hot market. Load post jumped 24% last week. Rates increased 21 cents per mile to an average of $2.99. Pittsburgh to Toronto, spot rates are at $4.36 per mile. That's about $1.25 per mile higher than this time last year and 23 cents a mile higher than this time last month. So wrapping up our market review of the week's activity in freight, dry van line haul rates have decreased by about 86 cents per mile since the start of the year, down another 2 cents per mile last week to a national average of $1.92. Comparing to previous years, that's 52 cents per mile lower than this time last year and about 7 cents per mile higher than 2018, still 30 cents per mile higher than the average for pre-pandemic years. In refrigerated, surging spot market volumes last week weren't enough to stop the reefer line haul spot rate from dropping. Last week down another 2 cents per mile, similar to dry van. The national average reefer rate ended last week at 222. That's 60 cents per mile lower than this time last year, and just 1 cent per mile higher than 2018, and still 28 cents per mile higher than pre-pandemic averages for the month of August. And wrapping up with flatbed, flatbed line haul rates have dropped by more than 4 cents a mile for the fourth week in succession. Since the start of the year, they've dropped about 38 cents per mile, but 36 cents of that has occurred since the beginning of June. So a rapid decline in spot rates in the last few weeks. National average ended last week at 229, still 1 cent per mile higher than this time in 2018, but 15 cents per mile lower than this time last year. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to DAT.com/market update and download our weekly report. This week we're featuring some tips from a long-time owner-operator who's run about 125,000 engine hours on refrigerated trailers, and he's giving owner-operators some of their best tips on how to run reefer motors at the moment. So with that, it's over to Ken for the short-term forecast.
Thank you, Dean. So we've got a little bit of controversy brewing here in our short-term forecasts. Before I get to that, let's talk about what this chart actually means. So the blue line is the actual historic rate that we've observed through our contributions. Again, that's based on $125 billion of annual contributed freight transactions, roughly 1,200 contributors. And I think roughly about 50 million actual loads contributed, not load board data, not factored data. So that's what the blue line is. It's a 7-day average, 7-day weighted moving average, excluding fuel. And then we have the green line, which is RateCast, which is our flagship model. That's available through any of our actual products, whether that be RateView, the RFP tool, DATIQ. And then you have 3 other supplementary forecasts that we provide exclusively through this show. The red is a short-term weighted forecast, which tends to heavily weight what's happening now as opposed to longer-term trends. And then you have the gray and the yellow, which are a blend of those two. So these forecasts have been in sort of violent agreement the past few weeks, certainly since Ned has departed, and I've been talking about them. We're just now starting to get to the point where they're going to start to diverge. And RateCast really wants to start thinking about the holiday shipping season, and don't we all, right? But this is an AI computer model, and it is thinking about post-Labor Day, that retail freight starting to move inland in the middle and final mile, getting to the warehouses and distribution centers and retail stores so that you can go buy stuff. The red short-term forecast is not so optimistic. It is expecting rates to dip down a bit and potentially have a lackluster start to the retail shipping season. So let's move on to reefer. Again, all the lines mean the same thing. A similar amount of disagreement towards the end, which I find is interesting because this isn't typically as impacted by the retail shipping peak. But through the middle of next month, pretty much all signs point to alignment before things start to kind of cone out a bit, if you will, borrowing that technical term. And now let's go to flatbed to wrap things up. We're going to have to move that y-axis down a little bit, it appears, on this chart. I'd say of the 3 equipment types, again, a little bit of a tease for our question here in a minute. Flatbed is worrying me the most. It's got a bit of a downward trajectory over these last, 5 or 6 months. RateCast is getting less and less optimistic that it'll be an immediate pull out of this decline, whereas the short-term forecast has it pretty much linearly going down to that 220 a mile, and potentially beyond. So that's our 3 forecast outlooks for this week. And with that, I'll turn it over to Dean for our IQ question of the week.
Yeah, thanks, Ken. Our question of the week is about the flatbed market. One of the questions we'd like to pose is, what do we think the impact will be on the flatbed market for the rest of the season?
And that is a big question, right? I mean, looking at this data, it's by far the most worrisome of the 3. Wouldn't you agree?
Yeah, I think so. It's reminiscent of 2017. I remember that market was sort of heading in this same direction before some big hurricanes, turned the whole market on their head. It's the most worrying because I think it's been the most robust. It's certainly been one of the strong performers in the last couple of years. during the economic recovery, but it's the way it's fallen off in the last few months is sort of consistent with how the housing market has lost a lot of its energy, because the housing market was the star of the economic recovery, but it's certainly cooled off in the last couple of months. So I don't see that changing before year end either. It's certainly worrying.
Yeah, I mean, the spot flatbed market is a lot more dynamic than the reefer or drive-in. It's a lot less commoditized. A large percentage of that type of freight moves spot, comparatively speaking, when you look at flat van or reefer, where you have a lot of upwards of 80-85% moves under contract. A lot of this stuff moves. We actually see more flatbed load posts in a typical week than we do drive-in or reefer, right?
Yep.
Just because it's a network hub for this type of freight that moves around. A lot of it's unplanned, unscheduled, and specifically one-off negotiated. And I think this decline was following 18 closely, which I think wasn't so bad, right? We were thinking as long as it stays above 18, accounting for fuel, carriers can remain profitable. Mm-hmm. But it's really closing that gap rapidly as it's come down.
Yeah, the thing with flatbed, Ken, is that a lot of the outbound volume shippers and carriers have control over, but of course the one-off project nature of flatbed freight means the actual destination can be wide. So that means you end up with a lot of deadhead miles, and that's why a lot of it has to go on spot. In particular, because if you start to get into over-dimensional freight and tarping and all sorts of special requirements for flatbed loads, you start to add in a lot more accessorial costs that couldn't have been planned necessarily into the contract negotiations. So, yeah, it's of course we're heading into winter too. Like fall and winter volumes too typically fall off. But some of the numbers that I've been tracking, Ken, show that there's still a lot of, even though housing starts down substantially compared to this time last year. Existing home sales are predicted to fall. There's been, mortgage rates are as high as 5.8%. But the number of houses under construction is kind of more of a worrying number, because there's been a growing backlog of incomplete houses. That's pushed up the number of new homes that are available. There's been lots of supply chain disruptions and labour shortages. But even though housing starts are down 8.1% year over year, the number of houses under construction is up 21% year over year, and that's been growing steadily due to the disruptions. And of course, a lot of that freight has been hauled, in particular, dimension framing lumber and roof on. So, worrying trend there for sure in the housing space.
Yeah, and it seems like a lot of the because you kind of have like an east-west dynamic, where west of the Mississippi, one of the prevailing macroeconomic factors driving flatbed is the shale region, right? The energy, whereas out east it's much more home building and construction based, and it's not just homes, right? It's retail, office parks. I mean, it's all like it's construction as a whole, sort of like I don't know what you classify it as, like all private sector construction. I think my hope would be that in the public sector at least, the infrastructure bill will help goose some of that. But again, I don't know what percentage of that is contracted versus, I have to imagine most of that is contracted through the GSA or something, as opposed to offered in the spot market.
Yeah. The other thing, I talked to Chuck Snow last week about the Canadian market. I was intrigued by some of the incredible rates and volumes we're seeing move between Houston and Edmonton. And he said that a lot of the volume that's happening up in the oil sands is they need about $70 per barrel of oil to make break even. And of course, they're way north of that at the moment. So they're investing a lot more in drilling activity in the oil sands, in particular north of Edmonton, which means that a lot of drill pipe and casing is headed north out of Houston, where a lot of the, especially, and energy products, other wind energy products also come out of Houston. So a lot of volume is moving on some of those lanes while oil prices are high. And I guess that's a good thing for flatbed carriers that run that cross-border market for sure.
For sure. Want to get to some questions?
Yeah, let's do that. What do we got here? First one. Jude Musawa Abbas, due to flat rate due to flat rates, brokers aren't paying a good amount for the load, not even $1.90 per mile, which is low for flatbed, I guess.
Yeah, I think that was a typo. I think they meant fuel due to fuel prices. I think, unless I was trying to follow along, and I think it was a typo that could have went either direction.
Okay, what's the reason?
If you're getting less than $1.90 for flatbed, I don't think I would accept that either. I'm assuming they meant fuel and dry van.
Right. Maybe he can jump back in with another comment there. While he does that, another question here from, I'm not sure who this is. Will the market change well before peak season? Will the market change well?
It's a big question, right?
Yeah.
I mean, if Amazon Prime Day was any indicator, people are still spending money. I mean, credit card delinquencies are not ticking up. Jason Miller had a great post on that earlier this week. Credit card debt in total is up, but debt per account is not necessarily anything to worry about right now. So my guess is that people are going to continue spending this fall. So my foundational supposition would be that, yes, we will have a healthy peak season. I don't think it'll be anything like last year or potentially even the year prior, but it should be as good or better than something like 18. What do you think, Dean?
Yeah, I think I tend to agree. I think this year is going to be pretty robust. The US consumer has been pretty resilient during some pretty difficult times in the last 2 years. I'm more concerned about early next year. I'm kind of curious as to what your thoughts are on what happens at the first quarter of next year when things typically quieten down. We've got a lot of inventory build up. Retail season typically ends around the start of the year, so the start of next year could be a precarious one.
It depends on how much lift we get from peak. I mean, I think we could very easily see like a seesaw effect where rates come up as you would expect for peak and then crash. I wouldn't be surprised if it was a very similar effect to what we saw in 21, right? So in 21, we came off that incredible 20 peak, and then rates crashed. I mean, just came down hard in February, and then we had the polar vortex and then Delta.
Right.
So I think the volumes will, the levels will be muted, but I expect a pretty similar shape. I wouldn't throw around the big R word, right? Mm-hmm. Recovery until late Q1 of next year. My thinking is that we won't see substantive recovery in the freight markets back to the next cycle until probably as late as 4th of July peak of that's early summer peak of next year. But that's just, again, looking into a very murky crystal ball.
Yeah, some of our good friends over at ACT Research this morning had a blog post out on LinkedIn talking about the other R word, which is a little bit concerning. I'm not sure they said it was imminent, but talks of a recession next year was certainly on the cards based on some of the indicators that they're looking at. So I'm not sure how that impacts our outlook, but that's some of the talk that's going on right now.
Yeah, I don't know. I mean, if we're talking about a macroeconomic recession, we can define it. I mean, how do you have a recession when everyone's employed?
Right.
And that's been the fundamental question, right? It's like typical recessions have a lot of these. It's not just GDP, right? There's a lot of other factors at play, and some of them are pointing towards economic malaise, and some of them point to, holy cow, things are okay. So
right.
It's hard to decipher fact from fiction in a midterm election cycle, right? Where typically you see a changing of hands of the Congress. So I'm struggling to find sound reasoning and research in this area right now that isn't colored by some of those factors. Right. So it'll be interesting to see. Next year should be the first real normal year. Exactly. I mean, a lot of the truck OEMs, a lot of the car manufacturers are saying, look to 23 to be the first year back to somewhat normalcy as it relates to supply chains, inventories, and all that kind of stuff. So,
yep. I talked to some large truckload carriers yesterday, and they said they're starting to get trucks out of factories. Things are returning back to normal on that front. Back to our first question from Sawar. Yes, fuel was as you suspected, Ken, for that question. So, I guess his question was why are rates so low when diesel rates are so high?
I mean, so we've talked about this on the show, and I really appreciate the question. The spot rate is set where the carrier and the broker, and I guess in some minute amount of cases, the shipper, are able to come to an agreement. So there's no one spot, right? If you look at Atlanta to Chicago, there are thousands of spot transactions that happen, probably tens, if not hundreds of thousands of spot transactions that occur in a given month. And what we're doing in a lot of cases is reporting out on a weighted average. So there's ones that happen higher, ones that happen lower. And although we tend to talk as if trucking is a commodity, it's kind of not, right? What's oil trading at right now, Dean? 90.
I'd have to look.
It's like $92. Right. If you went and offered Exxon $89 for a barrel of oil, they'd tell you, well, they'd probably use some expletives, but they tell you to go pound sand because they can sell it to a laundry list of other folks that are paying the prevailing market rate. Trucking is, I would say, mostly commoditized, but it still comes down to, in a lot of times, a phone call between a carrier and a broker. And if the carrier on the other end of that call is a better negotiator than the broker, they might be able to get more than the average rate on that lane. If the broker is a better negotiator than that carrier or has access to better information, they might be able to pay less than the market average. A lot of it's like buying a car, right? Some people, on average, a Jeep Grand Cherokee sells for $40,000, but some people pay 38, some people pay 42. That's just the way it goes, right? But you have Kelley Blue Book and TrueCar and all of these different services that help you hone in on what you should pay.
Right.
So that's how I would think about it. You had a really great follow-up question, Musawar, and I apologize if I'm mispronouncing your name, but you had a follow-up question about trucks grounding their fleets. And I think you couldn't have had a better follow-up for me to illustrate my point. That is what will drive rates up. I'm not encouraging you to do that. I'm just saying pulling capacity out of the market will increase the negotiating power of the trucks that remain, therefore resulting in people that need to move freight paying more, because as supply contracts, it necessarily moves the price up. And that is Econ 101, right? Supply and demand. As you shift supply down on the demand curve, it moves the price up. Same as if you kept supply constant and shifted demand down, right? Let's just say that you had the same amount of trucks in the market, but 10% less loads to move, price will go down. That's pretty much what we saw the last 6 months in the dry van market. So really, really good questions and conversation there.
Yep. Michael Onig wants to know what he's in for at DATcon, Ken.
So I'll tease it now because we have a couple other questions, but DATcon is October 5th through 7th in Austin, Texas. I would say predominantly you're in for one of the best kind of user-focused freight shows of the year. So we're not going to have the Wolf of Wall Street up there, but we will have the Blonde Bomber, Mr. Terry Bradshaw, I think 4-time Super Bowl champion for the Pittsburgh Steelers, my hometown team. But it really is a conference for the user. So we're going to have a shipper summit on Wednesday of that week with a bunch of blue chip shippers learning techniques for procurement, RFP, building resilient networks. Once we get into the broker sessions, which shippers are welcome to attend, we're going to have a bunch of learning labs. So my team will be there in force, helping you use our products, getting the most out of everything that you have in your arsenal. We're going to have speakers looking at the market from all different facets, from the shipper, broker, and carrier lens, trends we're seeing, new technology coming down the pike. It really is a working conference. I remember when I went as a speaker to 2 of these, I went home with a binder full of notes. And I had been using the DAT products for years, and I still learned new ways to use the data and the products to solve problems. So could not possibly recommend it more. You can head over to our website to register. I think you'll find that you get way more than the cost of admission, plus barbecue. And I would recommend staying that weekend for the first weekend of Austin City Limits, because Austin is a wonderful town for anyone who's visited to check out. So that's DATcon, 5th through 7th of October. Bradshaw, we'll all be there. Barbecue, couldn't recommend it more. All right, let me run through some quick LinkedIn questions that I'm skimming here. So Samantha Jones says, I was just going to say, it's a cooling construction housing market will definitely play a part, not to mention winter months are generally cooler anyway for new home builds. Only thing I would add there is winter is typically cooler, pun intended, for flatbeds north because people don't want to tarp. They have to be outside of their truck checking on securement of the load and things like that. So it's typically a seasonal downward pressure on rates up north for flatbed. I also appreciate Samantha's comment about student loans being the student loan forgiveness, putting some money and some confidence in people's pockets. That's something that's not talked about a whole bunch, mainly because I think people are trying to dissect what this actually means for folks. But I do think that will increase consumer sentiment heading into the fall, which will be good overall for shipping. Other than that, what are we missing?
Just our shout outs. I don't see any more questions. So,
all right. Shout outs. What do you got, Dean?
A lot going on. This is a very busy week. This week, let me quickly through them. Tonight, I'll be on Rates and Lanes with Chuck Snow and Rico Muhammad, talking US and Canada freight markets. That's at 7 p.m. Eastern on the Rates and Lanes podcast. Tomorrow, Sales Chatter with Dan Deegan and DJ Forrest at 9 a.m. Eastern. Also on Lampline now tomorrow night at 7 p.m. Eastern on Road Dog Radio. Channel 146. Of course, National Truck Driver Appreciation Week starts the week after next on 9/11. It's going to be a big week. We've got a bunch of videos that we'll be releasing from our week on the road with an owner-operator. And of course, as Ken mentioned, we've got DATcon coming up between October 5 and 7 in Austin, Texas.
Yeah, and I think in addition to DATcon, we'll have a presence at a minimum at CSCMP, McLeod, Mercury Gate, and a bunch of the fall TIA's Technovations. I believe we're going to have a presence there as well.
Right.
So it's really exciting as we get into this fall trade show and conference season to get out and see you all in person. It's always great to meet folks and have those interpersonal conversations, which we all dearly miss in a time of Zoom and Google Meets. But with that, we will sign off for this week. I recommend you check out Dean's market update online. Go ahead and check out the DATcon landing page on our website. And we will see you next week. Have a great week, everyone. Goodbye.
Bye-bye.